Hello, everyone. We are back with the monthly update of what's trending in CTA, the Simplify Managed Futures Strategy ETF. Per usual, I am joined by Charlie McGarrah, who is the Chief Investment Officer at Altus Partners, the Futures Advisor to CTA. Many of you have probably met him. If not, please reach out. He's always happy to get in front of clients and investors, and is a wealth of knowledge given his experience and oversight of the Altus Partners investment team. So, without further ado, let's dive right in. A lot has gone on year to date in regards to commodities as well as even some interest rates. I think we kind of forgot that interest rate futures are part of the CTA portfolio because we've been so focused on precious metals and now oil and gas in the last couple weeks. But we'll have some more insight on how some of the interest rate positioning has been driving performance, positive performance in the last couple weeks. Charlie, you can see my screen now, right?
I certainly can.
Okay. So I'm going to dive right in. I just want to pause for a moment because I think if we backtrack to kind of early 2025, it was a really challenging environment for trend following. And many of us on this side of the fence were talking about how typically when we see these historic drawdowns in trend following, they are then followed by really strong periods of performance. And that's really what we've seen over the last couple months. I think the rise in precious metals and now in oil and gas and just commodities broadly, it's given trend following strategies a lot to hook onto. And so if you look at the annualized return of CTA since inception, we are now over 11% annualized return. And I stress this because oftentimes when we talk about trend following and managed future strategies, we lead with the core objective of being a diversifier. And many of us, unfortunately, have become accustomed to the fact that diversification means sacrificing returns. And so I really just want to be very crystal clear that CTA is such an excellent proof point of when diversification does not have to mean sacrificing return. And I'll go as far as to say, like, having your cake and eating it too. And I think that's really important for you as an investor, as an allocator, when you're having conversations with clients, that becomes increasingly difficult when your alternative and your diversifier part of the portfolio just lags from an absolute performance. So over 11% annualized return on an absolute basis is wonderful. On a relative basis, we've also really crushed our benchmark, which is the SocGen CTA index, almost 8% annualized excess return since CTA launched in 2022. And also, I might mention we are about to hit our 4-year anniversary in the beginning of March here. So, really exciting. We've delivered on performance, we've delivered on diversification, and you see that here in the correlation to both the broader US equity market and US aggregate bond market, negative correlation to both stocks and bonds. So, again, getting your diversification and an attractive source of absolute return. And then we've also received the question quite a bit too, especially with all the focus on commodities, because CTA does have a decent amount of that exposure. Is this redundant alongside kind of a static or even dynamic commodity allocation? And I would say, as you see here, really low correlation to broader commodities as well. So this is really a really solid, strong diversifier, even alongside some of the commodity allocations. And then lastly, thinking about when CTA and trend following strategies matter the most in those times of equity market turbulence. It's been a really flat year for US large cap equities. And CTA has averaged monthly return of positive almost 2.5% when S&P 500 has a negative monthly return. So really solid positive upside convexity, or sometimes we call it the crisis alpha that CTA can deliver. So hopefully that's a pretty attractive narrative. We're very excited to talk to our investors and our clients about CTA for those reasons that you see here. So as I jump forward, again, just rehashing for those of you that may be new to the land of CTA, we are focused primarily on interest rate and commodity futures across developed markets in North America and Europe. We have intentionally excluded equity and FX, and that's to maximize the diversification benefit alongside your traditional stock bond portfolio. And all the markets that you see here are eligible to be either long or short positions in CTA. Please reach out if you guys want to more understand the investment process and how we kind of determine positioning. But I think this is such an excellent proof point going back to that diversification objective that I mentioned. This goes back to the inception, again, March of 2022 of CTA, which is the white line. And I like to say it doesn't matter so much what line is on top, although, again, positive absolute performance does not hurt the portfolio. But you see this nice ebb flow zigzag pattern between the white line and the orange line being a 60/40 portfolio. And this is my favorite chart, my favorite visual to just really instill that power of diversification and how this can benefit a 60/40 portfolio. Let's talk a little bit about recent performance. Again, the year-to-date period has been quite strong. That's what you're seeing here on the far right. The white line again is the CTA Managed Futures ETF. The orange line is the SocGen CTA Index, which is really the industry standard benchmark for trend following. And you see really in the last couple weeks of February, CTA pulled ahead nicely relative to the benchmark. And then you'll see on the far left, Morningstar rating. We're currently a 4 star as of the end of February, and then really looking at those longer term results in a category of systematic trend in Morningstar. We're ranking about the top 20th percentile since inception. And I think even with the first couple days here in March, which we can talk to as well, that performance gap is widening even further for us in our favor. So let's get into the good stuff, which is really more of the performance attribution. I've left the column of 2025 in here just as a reference point. 2025 was a pretty challenging year, and so I think it really just shows how important the last 2 months of 2026 have been for trend following, kind of coming out of the 2025 glut. So maybe I'll pause and hand it over to Charlie to talk about some of those contributors, starting with like the month of February, because I think there's some interesting futures contracts in here that many of us might not expect to be some of the top contributors for Feb.
Yeah. Well, thanks, Paisley. It's been a pretty strong start to 2026 with a lot happening in the market. I'd say it's sort of a tale of sort of two commodity sectors. Metals were unbelievably strong in January, followed by a wild pullback, a truly epic pullback in silver, kind of collapsing on the last day of January, and then also into the first day of February, with what felt like a very large position unwind of the rumor being retail traders in Asia trading with lots and lots of margin, but it felt like a big, large margin call kind of squeeze into the whole space. Now, at the same time, here toward the end of February, as the pricing of geopolitical risk and possible disruptions in the energy supply chain are rippling through the system, energy is getting a bit more spicy, and so the sort of hydrocarbon complex, especially oil and products. Now, nat gas has also been super volatile, but actually kind of worked from the short side, except we had an incredibly cold snap in mid-January that washed out some of the shorts in nat gas because the front of the curve spiked. So it's just been a really wild ride in commodities. But the basic idea is first metals, then hydrocarbons. Now, kind of caught up in that, and maybe a little bit less understood is ags have been in this downtrend of a sort of food glut, but then turned. And again, it's that and just like oil, where it's been pretty tough as a bull to be bullish oil, and the market's been talking about kind of the desire of policymakers globally to suppress core inflation by keeping anything with a carbon hydrogen bond, whether it's hydrocarbons or whether it's carbohydrates. Either way, the idea is keep that inflation driver down. But that's really started to turn in February. And so grains have been working on the bull side, and oil and products have been working on the bull side. Yeah, and metals have kind of calmed down as the risk has gotten pretty big. Now, one of the things I find that's been pretty interesting, and a little bit more under the radar and all that, is that international bonds have had a really nice long trending rally throughout the beginning of the year, and Italian BTPs are they're interesting for two reasons. The first is that the curve is mildly upward sloping in Europe. And the second is that Italian spreads are a little bit wider than spreads for places like Germany. And so the combination of the yield from the extra yield from the duration and the extra spread has made sovereign spread has made the carry trade there pretty good and had returns chasing all throughout February, driving a really nice bull trend in Italian fixed income. That bull trend away from JGBs in Japan, where it's a completely different beast and kind of re-rating fiscal dynamics. But in Europe and other international markets in like Canada, we've seen a nice bullish trend in bonds. Now, with the first couple of days here of March, which I'm sure we'll talk more about in next month's recap, there's been a pretty big pullback in some of these fixed income markets on the back of inflation uncertainty from an increasingly disorderly movement in commodities. But at least for the month of February, it sort of went under the radar that there was this really nice trending bond rally in international fixed income. But the system did catch that very, very nicely for a combination of both trend and carry indicators.
Yeah, maybe a comment I'll quickly make too is just focusing on the table on the top left. Again, coming out of 2025, commodities really kind of drove the narrative for positive performance, and interest rates broadly were a bit of a headwind. So it's wonderful just to see both the interest rate and commodity allocations working in tandem to drive really strong positive returns. And I also think too, as it relates to some of the month-to-date positive contributors that Charlie just highlighted, I even was surprised as I started to look at some of the drivers and running some of this attribution is trend following has the ability to really find these niche pockets of the market and benefit from either being long and short. And some of these we were long, some of them we were short, like cocoa perhaps. And so it just goes to show the power of how diversifying these strategies are. As much as, the headline gold, silver, oil, gas narrative has been this year, and those have been really strong performers with some heightened volatility. There's so much more diversification and so many more markets that we can benefit from. And I think that's one of the key differentiators of CTA is that we do have these niche parts of the market and more diversified exposure relative to just the headline commodities or the headline rates that you see. And so really delivering Altus Partners, true hedge fund type approach to trend following in this
Well,
daily liquid ETF.
one of the really cool things about trading using algorithms in a computer is that um, as a human being, we have limited bandwidth to pay attention to things. I can only focus on a few things every day, I suppose. But the computer's listening to the market. Now, a human being is typically smarter than a computer, at least for now. But the computer has a much broader breadth of the things it can be paying attention to. And so it is interesting to see like a Coco there where there was just a sort of short after, the fireworks on the bull side a year or two ago. Now the market's kind of gone the other way and the system's listening and you just got a little piece of that action on the way down.
Yeah, and just to reiterate too, because we have gotten this question after these monthly videos in the past, is like, is there discretion? Is it entirely rules based? Just to be crystal clear, CTA is fully systematic, rules based. Neither Altus Partners nor Simplify, as the trading PM arm of this strategy, are making discretionary overrides. But as Charlie mentioned, I mean, the model speaks for itself and the dynamism that it brings to market exposure. And I think this is also a really helpful visual is in this state of markets and global growth shocks and geopolitical risks, having a static approach to markets can be frustrating at times. You've made a decision to allocate to a strategy. It is what it is, so you know how it's going to behave. And when the market is not positioned to benefit in that type of environment, it can be really frustrating to you as an allocator. And so I think this proof point here on this slide of how dynamic, flexible, agile trend following can be just really shows you how adaptive it is in these environments that are shifting weekly and monthly. And so you'll see here the black line is the commodity exposure over the last roughly 12 months. The gold line is our interest rate exposure. And you can see how we're scaling quickly in and out of commodity markets as well as interest rates, which tend to be a little bit slower moving in nature. But rest assured, CTA is not asleep at the wheel, constantly evaluating, fluctuating, and kind of shifting as the market and the model assesses. I think this visual is also really helpful. We don't typically spend a lot of time on these slides, but really looking at the far left, all of your commodity allocations, and then on the far right, interest rate positioning. And all of this information we can send to you guys as follow-up, but just showing kind of how agile again and flexible some of these are and how they move from quarter to quarter or year to year. And so we are not beholden or set on being long or short any specific market. We are really just looking at the underlying trend and some of the macro factors, as well as the carry profile of interest rates to determine what is advantageous from a performance perspective. So with that, I don't have anything else. I think next month's update is going to be really fascinating. I think um, I mean, even just this morning, hearing that, some of the tensions and uncertainty with what's going on in Iran is likely to persist for the next couple weeks. So a lot could happen in the next few weeks. So please tune in next month to hear how CTA has delivered. But again, Altus Partners as well as Simplify is always here to answer any questions that you may have. And thank you guys for your continued support. We hope that you find these insights and updates helpful. So thanks, Charlie, for joining me as always.
Very welcome. Speak soon.